In 2026, the market could give you the single best buying opportunity of your entire life, and most people are going to run away from it in pure panic. Today, we're going to talk about why 2026 might be the year everything breaks, why that might actually be good news for patient investors, and what you should be watching right now before this thing sneaks up on you. Let's get into it. So here's the big idea. 2026 is shaping up to be a perfect collision between three massive forces: interest rates, government debt, and corporate earnings. Individually, manageable. All at once, that's where we get the once-in-a-lifetime setup. And here's where it gets interesting. This isn't about predicting some cartoon-style apocalypse. It's about understanding that the math, the timing, and the psychology are all lining up in a way we almost never see. If you're under, say, 50 years old, you probably haven't lived through anything quite like what could be coming. Well, except me. I fell into a literal well as a kid, so I've technically lived through falling into a deep hole before. The difference this time? The hole is full of treasury bonds. Let's break down what's actually going on. The last few years have been this weird, unstable combo. Insanely low interest rates for a decade, then a violent jump higher in a very short period of time. For years, governments, companies, and regular people got used to borrowing at almost zero. 0% became normal. Cheap money wasn't a policy. It was a lifestyle. Then inflation pops off, and suddenly rates go vertical. That doesn't show up in full pain immediately. There's a lag. Debt rolls over slowly. Companies refinance at maturity. Mortgages reset. Government bonds mature and need to be replaced at new, higher yields. And that lag? That's what starts really biting in the mid-2020s. A lot of the debt that was issued when money was free is going to come due and need to be rolled at much higher interest rates. That means higher interest bills for governments, higher interest costs for companies, and a lot of pressure on anyone who assumed this 2% money lasts forever. But wait, it gets even better. Because at the same time as this rollover wave is hitting, you've got equity markets that have basically been partying on the assumption that the Fed will just fix it every time there's a wobble. Bad news? Rate cuts. Rate cuts? Asset prices go up. Rinse and repeat. This is where 2026 gets spicy. By then, the cumulative effect of higher rates and bigger interest bills could be so large that the market finally stops believing in the Fed can save everything meme. Not because they're powerless, but because every lever they pull has a nasty side effect. Cut rates too aggressively, you risk inflation coming back. Don't cut enough, you risk something in the debt system snapping. Either way, confidence cracks. And confidence is the real asset class that holds this whole thing together. So what are the key takeaways from all of this? First, the problem isn't just rates are high. The problem is the combination of very high debt plus structurally higher rates compared to the last decade. Think of it like this. If you owe nobody money, higher rates are annoying. If you're buried in debt, higher rates are a death sentence. Governments around the world are deep in the hole. Decades of spending more than they take in, rolling short-term debt, issuing new bonds to pay off old ones. That worked fine when interest costs were tiny. Now, interest is starting to become one of the single biggest line items in budgets. When the interest bill starts crowding out everything else, social spending, defense, infrastructure, that's when bond markets start asking, are you guys good? Or are we just pretending this is fine? And here's where things get even wilder. If bond investors start demanding higher yields to compensate for that risk, that pushes rates up more, which makes the interest problem worse, which makes investors more nervous again. Vicious cycle. On the corporate side, companies that gorged on debt in the easy money years are going to hit a brick wall when it's time to refinance. Zombie companies, those that only survived because debt was cheap, get exposed. Their earnings can't support the cost of capital anymore. That means bankruptcies, layoffs, down rounds, fire sales, all the fun stuff you don't see in bull market marketing decks. Now add in earnings. If the global economy slows under the weight of all this debt and higher rates, corporate earnings will compress. But equity valuations today in many sectors are still priced like growth fairy tales will continue forever. In 2026, the shock could be that everyone wakes up to this mismatch simultaneously. Earnings coming down, discount rates staying higher than we're used to, and debt costs spiking. That's when you get sharp repricing across risk assets, stocks, junk bonds, real estate. And before you say, well, they'll just cut rates back to zero and we're good. Remember, inflation hasn't magically disappeared as a concept. Central banks don't have unlimited political cover to print their way out forever. That's the real, once-in-a-lifetime piece here. We're potentially heading into a world where the old playbook, cut rates, print, repeat, has real constraints. The candle has been burned from both ends. Too much debt and too much inflation risk. So what does all of this mean in practice? It means 2026 could be the year when asset prices finally reset to something closer to, this is what things are worth in a world where money isn't free. It means people who've only ever seen buy the dip, it always comes back fast, may learn that sometimes dips turn into multi-year slumps. And that's where generational wealth gets quietly built by the people who didn't panic. Now, here's where it gets even more counterintuitive. If you're prepared, a crisis like this is not just survivable. It's an opportunity that might not repeat in your investing lifetime. Stocks you'd never touch today because valuations are insane? They can end up trading at prices that look laughable in hindsight. Quality businesses with durable cash flows get sold off along with the trash because in panics, nobody discriminates. People don't sell what they want, they sell what they can. But if you go into 2026 loaded with leverage and overexposed to the riskiest stuff, you don't get to play offense when that moment arrives. You're too busy getting margin called into oblivion. So let's talk about what to actually watch from here. First, keep an eye on government interest expense. The more that line item grows as a share of tax revenue, the more pressure you'll see on bond markets and political decision-making. If interest costs start to look like the second or third biggest budget item, you're not in normal cycle territory anymore. You're in the system itself is being questioned territory. Second, watch the yield curve and bond auctions. If you start seeing persistent stress, weak demand at auctions, yields spiking unexpectedly, central banks stepping in more and more to stabilize things, that's a sign the market is starting to push back on the current setup. Third, track corporate refinancing waves. When are big chunks of corporate debt maturing? Are high-yield spreads widening? Are we seeing more companies struggling to roll over loans without paying huge premiums? That's the canary in the credit coal mine. Because when credit tightens, it doesn't show up as a breaking headline like stock market crashes. It shows up as a slow grind. Funding dries up, expansion plans get shelved, layoffs begin. Only later does it turn into the obvious stuff. Earnings misses, guidance cuts, stock price collapses. Fourth, keep an eye on earnings versus valuations. If stock indices are still trading at rich multiples while earnings growth is slowing or turning negative, that rubber band is stretching. When it snaps, it tends to overshoot on the downside. But wait, it gets even better. Because all of this is happening against a backdrop of massive structural forces. Aging populations, slower productivity growth, and ongoing geopolitical tension. That means governments are under pressure to spend more on healthcare, on pensions, on defense, at the exact same time that debt service is exploding. Which brings us to the uncomfortable question, how do you fix a debt problem this big? There are basically four ways: grow out of it, inflate it away, default, or some messy combination of all of the above disguised as policy. Growing out of it would require serious productivity improvements and real economic growth, not just nominal numbers juiced by inflation. Inflating it away means negative real rates for a long time. Your money quietly loses purchasing power while the nominal debt becomes more manageable. Default? Let's just say no major government wants that word anywhere near their name. So what's most likely? Controlled chaos? A mix of above-target inflation, financial repression, and periodic accidents, where parts of the system blow up and get backstopped. That's why 2026 is such a critical zone. It's far enough out that these slow burn problems have time to accumulate. It's close enough that you can't just shrug and say, hey, that's a 2050 problem. So how do you position yourself for a world like this without going full doomsday prepper? First, don't base your entire plan on rates go back to zero soon. Could they come down from peak levels? Sure. But the idea that we're heading straight back into a decade of free money, like 2010 to 2020, is basically copium. Second, stress test your own finances. If your investments, your business, or your personal life only work as long as money is cheap and asset prices go up, you're not investing. You're gambling that the last 10 years were normal and permanent. Ask yourself, what happens if funding dries up for 2 to 3 years? What happens if your asset values drop 30 to 40% and stay there for a while? Are you forced to sell at the bottom, or can you ride it out and buy more? Third, understand that volatility is not the enemy if you're prepared. The enemy is being forced to act at the worst possible time. You don't drown because the water got deep. You drown because you jumped in without knowing how to swim and couldn't get out when the current changed. Fourth, be selective about risk. In a distorted market, everything goes up together. In a cleansing event, the difference between quality and trash suddenly matters again. Profitable, cash-generating companies with strong balance sheets become survivors. Hype-driven, profit-free, debt-heavy stories become cautionary tales. And here's the twisted part. During the panic, they'll all get sold down. That's where the once-in-a-lifetime opportunity hides, in being able to tell the difference between temporary markdowns and permanent impairment. So when you hear 2026 might be a once-in-a-lifetime event, don't picture a single day where everything explodes in a cartoon fireball. Picture a multi-year process where inflated expectations, easy money illusions, and real-world constraints collide, and where, somewhere in that chaos, there's a window where assets you've always wanted to own are trading at prices you might never see again. Not if, when. Most people will be emotionally unable to act when that moment comes, because the narrative at the bottom is always the same. This time is different. The system is broken. It will never recover. We've heard it before in 2008, in 2000, in every big reset. What could be different this time are the tools available to policymakers and the constraints they operate under. But human behavior? That part doesn't change much. People panic, people overreact, people extrapolate the worst moment forever into the future. Your job is not to be smarter than everyone. Your job is to be less emotional than everyone. Now, a quick reality check. None of this is guaranteed. We're talking probabilities, not certainties. Maybe we muddle through with slow growth, mildly elevated inflation, and no spectacular crash. But when you see debt levels where they are, when you see the cost of capital shift as hard as it has, and when you think in multi-year cycles instead of daily price candles, you don't need a tinfoil hat to say, yeah, something big could snap by 2026. So the question isn't, will something happen? The question is, if it does, are you one of the people forced to sell into it, or one of the people waiting with a shopping list? I know which side I'd rather be on. And look, this is not financial advice. I'm just some person on the internet who, as a child, fell into a well and apparently decided, you know what, let's do that again, but with the global financial system. Do your own research. Run your own numbers. Talk to a qualified professional who knows your actual situation. But don't ignore the signals just because the last decade trained everyone to believe central banks are invincible and asset prices only go up. The 2026 market shock that no one expects is exactly the kind people only recognize in hindsight. The people who benefit from it? They're the ones thinking about it now, calmly, rationally, and earlier than everyone else. So now I want to hear from you. How do you see 2026 playing out? Slow grind, sharp crash, or just another fake scare on the way to higher highs? Drop your take in the comments. And if you want more deep dives into where finance and the real economy are heading next, hit subscribe so you don't miss the next one.